Hey guys, welcome back to the Capital Mindset Show. Today's going to be a video about Netflix. I want to actually give you guys a warning that it might be a little bit of a long video. I know some of you have very precious time, but thank you so much for watching. And at the end of the video, if you did find value at some point, go ahead and feel free to leave a like. And if you want to subscribe, you can subscribe. I also want to let you guys know that there is a link to the Discord community down below. It's completely free if you want to join. I also want to make an announcement about that. We have been talking about the stock, by the way, but a little bit of an announcement as far as the filtration process goes. You have to sort of verify yourself by answering a couple questions. It is because the Discord community is free to enter, so we had to protect it in some way. You know, some other communities they have paywalls, and that services as like a shield to block the spam from entering the Discord community. So we figured out a different way to do it. And so please, when you join, answer this question. I have noticed that a couple people, there have been a lot of people, the vast majority of people are following the prompts and answering it properly. You know, maybe, I don't know, maybe the ones that are failing are the ones that are, spam bots. So it could be that it's just working, but just in case, if you guys were confused and tried to enter the community and, saw that it was empty, it's because you have to enter the following prompts. Otherwise, the bots / the moderators will not be able to let you in. Okay. On that note, let's get right into this. So I will be going over not only my thoughts, but other creators' thoughts as well. We'll be going over larger creators and reviewing some of the lessons that we've discussed in past videos about Netflix. So we'll also be looking at my last video that I made about Netflix. It's all on the channel. And so, that will be kind of like a shout out to my older videos. But we'll actually start off with my older video. And, you can look at this yourself, but if you go to timestamp 14, I give my conclusions. And let me show you the title of this video. It's Revisiting Netflix After the Drop, because there was a drop before when it was above $400. And you can see here in this video, when I'm talking about it, it's about $384. Okay, so if you skip over to about 14, because I don't want to waste your time, and you don't have to watch the whole video, but right here. Say that I'm 100% interested in this business, I would set up a plan. And that plan would consist of, right now I would be nibbling. Okay, I would just be buying some shares here and there, and then kind of just watching it. And then if it ever were to come down, I would then add more and more and more, right? And I would actually build up the position, right? But at current prices, I'm not comfortable with the projections I have to make in order to justify the investment. But you know what? For me, I think this business has a lot of potential, especially with what they're expanding into gaming and what they can do there. I think there's a future there for them. But I'm kind of I would love to pay a lower price so that I don't have as much risk on the table. And I think it's possible. If things get a little bit more crunchy in terms of liquidity in the markets, we could. All right, not to waste everyone's time there, but I recommend if you want to see the full conversation about it, watch that video, or I think I talk about it a lot in the live streams. In the very last live stream, for those of you who are in attendance, or I think the one on last Friday, I did actually say that I wasn't adding more Netflix, I was waiting for something, to occur, and this might be it. We'll actually discuss that, and you'll see it towards the later parts of the video. We'll go into the evaluation, but I highly recommend you stick for the part of the video where we're going to go into the market analysis. And this is going to be more of a deep dive, okay? Now we're going to move on to another creator, much larger creator, and this one is Everything Money. So Everything Money, again, here's their video, and that's the title. It was posted just the day after, so they kind of took advantage of the timing. But I would say that my only commentary for this, and I have commented, and I'm sorry, Paul, I don't want to make your face look bad like that. There we go. Much nicer face. I didn't mean to do that. That wasn't on purpose. But my issue with Everything Money's evaluation is that they're actually looking at this point from the perspective of cash flows. And we've discussed in the past why that's a noob tier mistake, because every company in the stock market, and that's a big lesson of capital mindset, is it's very nuanced. So depending on what type of company you're looking at, depending on the sector, you might have to change the aspect. The underlying principle is more or less the same. And yes, the value of any business is the present value of all future cash flows. However, because of how we account for things, right? Basically the accounting principles, how we account for things in certain cases. It changes the methodology in which we must look at a particular business. So one business can vary from another business. I think that's fairly basic, right? So when we look at something like Netflix, we want to be careful not to look at the cash flows from operations as kind of like the end-all be-all, because then we're going to punish the company for what we call growth CapEx, right? Growth CapEx, and that's a big lesson to learn from something like Amazon, right? And so a lot of people don't really talk about that. I think Amazon is a beautiful case study of what happens when you ignore growth CapEx, and in your valuation models, you punish a company for that growth CapEx. You are going to misevaluate it, and it's a newer tier problem, right? When you're newer to the market, when you don't understand the intricacies, it's easy to make that mistake, especially when you just found out. You know, the confidence curve, when you just find out about, you know, discounted cash flows and all that, and you took your Finance 101 class, you're fairly new, and then you're like, oh, I can just put an NPV in an Excel and I'm done. Well, here's the thing: when you don't take into account the intricacies or the nuances hidden within the cash flow statement, you can miss out or you can misjudge something. All right, so that's a big deal, especially when you go out into the field and you work. If you're trying to judge a project, right, and then you misevaluate it, you know, your boss might be quite mad at you. That's a little bit of a problem. So every project, every business must be looked at in isolation, and you got to think a little bit outside the box sometimes. So growth CapEx, you don't want to punish a company for that. Netflix, we'll get into that a little bit more later in the video in greater detail, but just remember this statement: you don't want to punish a company for growth CapEx, and they're using free cash flows. Of course, I'm not so against their price targets, because we'll get to the price targets, or not price targets, but buy prices. They're not out of the realm of possibility, but I'll show you another creator here, who this creator has a CFA. I think this is a good face. I just don't want to pause at a place where, you know, if someone might think that I'm trying to, like, you know, make them look bad in that case. But this individual is a CFA. You can see down there in the title. And by the way, I just found these people just by, you just type in Netflix on the search bar, and this is what really comes up. So this is why you're here. It's not to pick on you in particular. You're just here because of that. I skimmed through your video. I found you had a very interesting form of evaluating it based off of EBITDA, which I thought your EBITDA evaluation, if somehow you watch this video, was fairly accurate in because of some key points. There's a reason why EBITDA in this instance would be more accurate than your cash flow valuation. Because again, this person right here, the one we're seeing right now, this $106 one, this is based off of cash flows. And the problem again with the cash flows is you're punishing the company for growth CapEx. So while it could actually still get to that price point, you're right for the wrong reasons. And I think sometimes being right for the wrong reasons is worse than being wrong, just flat out wrong. But your EBITDA valuation, because I want to give credit where credit is due, and I want to try to find that one. And we will move on. You see, this is the EBITDA valuation, and it came up to a $244 price target. Not saying that that's perfectly exact, but the methodology I'm saying is precise. I've seen other videos of this individual in the past. This individual is quite aggressive in their valuations typically, so they lean on the more aggressive side in some instances. So, you know, I don't still think that's the most accurate price target or buy price, or I think where I would buy it. It's subjective to this individual, but I think it was a better methodology for a particular case with why EBITDA in this instance might be better. Okay, and there's a reason. All right, but EBITDA is still not probably the most accurate form to evaluate Netflix, but it's better than cash flows in this instance. And again, we'll get to that. Now, for the last person that we're going to discuss, this is the person that shows up the most. All right, the most when you look up NFLX stock, what I found to be. So it is this person, Joseph Carlson. So Joseph Carlson, people have requested me to review Joseph Carlson's portfolio. This will not be a review of his portfolio. We're just going to be focusing on Netflix. And I want to showcase the evolution of this individual. And nothing against you, Joseph. I will say this, you know, straight up to you. I think that you need to hone in on your skills in terms of evaluation. just a little bit of a particular note here. The majority of your portfolio, or the majority of this person's portfolio, is based off of the story-driven aspect of investing and not the analytical. And you have to have both. You know, you don't want to be purely analytical and you don't want to be purely story-driven. This person's portfolio is primarily story-driven, and then we're going to see what occurs as your thesis is primarily story-driven, and we're going to see your evolution over the same time period, where I think that I've maintained a fairly consistent viewpoint, and if you're on the analytical approach, you will typically remain consistent. So, like, for example, credit where credit is due, Everything Money may be incorrect in terms of their analysis. However, and this is my opinion, however, they're going to remain more consistent because they're from the analytical approach and not the story-driven approach. So I've talked about the pros and cons of being purely analytical and purely story-driven, or, you know, again, what I believe is ideal, which is a mix of the two and leaning more on the analytical side. But again, we'll see this. So let's first talk. We'll first listen to him in the beginning, and then we'll move on to the next one.
I'm going to say a sentence that I don't think you hear too often. In fact, you probably hear the exact opposite. Netflix is an undervalued company. That's what I believe. I believe it's an undervalued company. Most people would think that's crazy to say. You look at the stock chart here and
all right, and I wanted to show this because this is what he stated, and that was the share price. Again, not attacking Joseph Carlson. This video is not to review his portfolio or anything like that. It is a case study for my audience to see the problems that can occur as a newer investor when you're primarily story driven. And again, this person said, and I think, by the way, and we'll see the evolution of it. But that's the highlight. I think, by the way, a 900 could happen, but depending on the time frame you're actually putting on there. So I want to say, like, okay, if you said like 50 years, probably, I don't know, but we'll get to this. So this is when it was $500 a share, and this person is saying it is undervalued.
People say it's $530 a share. The PE ratio is 90.6 on Netflix currently. This is an expensive company. It's super expensive. If you're buying Netflix, you're buying an overvalued, expensive.
All right, and then if you guys want to watch the full video, you can see the title here, obviously. All right, so now we're going to move on to another video of this person. Netflix is stealing Disney's lunch.
Welcome, everyone. Thank you for joining. I just wanted to jump in real quick and give an updated analysis on the company Netflix. As most of you are aware, I have a large investment in Netflix. I currently have,
and I want you to pay attention to how much he's up here, 20% or 19.66%.
I have $14,000 of value in it. I just bought an additional like $3,000 of Netflix. Even after this recent run up, even after it being called so expensive, the more I think about this company and the more I consider the entire market, the competition, whether it's Disney Plus or HBO or Amazon or Apple, when I consider the total addressable market and their positioning in that, their business model, the leaders of the business, the downside, I like this company more and more. So even though the price is going up and I'm buying high, I continue to buy this company. And in this video, I wanted to explain why. Why am I still so bullish on Netflix? Why do I like this investment so much?
Okay, so I'm kind of, again, showcasing here, and it's a case study. It's not to poke fun at you or anything like that. It's a case study for my audience, because I think from my perspective as a person who's trying to provide value to you guys, my audience, this person is a beautiful case study of a story-driven investor. And you can see that the arguments laid out forward, and if you watch the whole video, you kind of see the same thing. It's very story-driven. And actually, fittingly enough, I think he calls that fund the Story Fund. So it's a very fitting name. But, you know, it's kind of almost a self-aware kind of thing. But we're going to move on to a further evolution. So this was posted on November 16, 2021. And let's move on to January 20, 2022. I think this is a similar time period. We posted 2 videos on Capital Mindset, actually, regarding Netflix. The original one was posted at the very beginning of January, and then there was, again, I'll bring us back here. This one was posted at the end of January. So not that one yet, this one.
Well, this looks kind of bad. Straight from The Verge, it says Netflix stock plunges as the company misses growth forecast. Investors aren't pleased. All right, Verge, speak for yourself. I'm a Netflix investor. Let's go ahead and see how not pleased I am. Let me go ahead and zoom in on this. We'll go through the news together. This doesn't sound good, though. The stock is plunging. Netflix investors have been worried about the company, that the company isn't adding subscribers fast enough. And today they started to panic. Netflix investors are in a full-on panic. This sounds really bad. After Netflix reported lower than projected.
All right, summary, because I don't want to sit through the whole video. Summary, he's not panicking. It's not that bad. Story-driven stuff, okay? And then let's move on to this one, where this is the most recent one, posted April 19, 2022.
Well, let's go ahead and jump right in. Netflix is down 25% plus after hours. They released their earnings just a few minutes ago. I took a look at the earnings. I looked at them ahead of time, and I think this sell-off is kind of deserved. This report was disastrous. The last time that they sold off, I didn't really think that. In fact, I thought it was a little bit overblown. We can look at Netflix as a unique stock for me because it holds 2 consecutive records of the biggest sell-off after earnings. This company just drops like a rock after earnings. The first time was right here. It dropped 20% in one day, and then it traded down to 30% within just a couple of days. Then we had Bill Ackman buy into it. The stock traded up a little bit, got some.
All right, point is, again, watch the whole video if you want to, because this video would be way too long if we do reactions on all those videos. But the point is, now he's kind of more cautious. He's now, getting a little scared. So we just saw the evolution of an individual who, again, if you're a story-driven investor, I hope that message was taken by you, the audience, that you can see the evolution of a story-driven investor from the point where they were saying it's going to go to $900 a share when it's sitting at $500. And then as it's coming down, then, their story is fading, and now to the point where they are questioning it. Right? And this is the problem when you remove the analytical side of investing and you go for that. Now, there are problems when you remove the story side as well, because then you don't look past the numbers, and then what Buffett would say is you can miss fantastic businesses and you just look for cigarette butts. And then that can be very dangerous form of investing, because odds are you're not as intelligent as you think you are, and there is something that you're missing in that cigarette butt investment, and you're going to get your, so to speak, you're going to get your cheeks clapped. Okay, so I want to actually keep that in mind. Okay, and then now I want to bring us forward to this video, which was posted prior to the recent sell-off. Okay, so this was posted on April 13th, 2022. And again, I'm not picking on you, Joseph. It's not to make fun of you or anything like that. This is the story fund. I think the story fund is down in total 15%-ish. And taking a look at Netflix, it says Netflix is down in this portfolio by about 74.85%. And this is before the sell-off. Okay, this is before the sell-off. What I will highlight to my viewers here is the sizing of the position within the portfolio. At a 15% position sizing, this indicates to me, if I'm just a unbiased viewer, bystander, looking at your portfolio, that is a high conviction play. Okay, so high conviction means that you must have done as much extensive homework as possible, and you are so confident in the prices that you purchased to make it such a large position in your portfolio. So I'll kind of showcase, and you know what, I'll try to find that now for you guys. But I think it's important that, and I actually want to state, if you guys go check out the portfolio now, it's already been updated, but I took a screenshot of before the update, because I actually want to make sure you guys get a good look at that. Let me put that in full screen. Okay, so this is the portfolio before the update. And I want to show this to you guys, because now it doesn't show as much of a drawdown, but I wanted to document that, yes, the portfolio, the position of Netflix was down 36% before I resized the position. Which, spoiler alert, I resized the position. Gosh, I was supposed to wait till the end of the video, but now you know. But we got to get into why, okay? And there's a lot of reasons why. So you see Netflix went from $350 and now, which was the average cost previously, and it's now was down when I took the screenshot to $224.01. And I took the screenshot before the portfolio updated. You can see the last update was 4/14/2022. And I think this was after I sold all of the, not all of the, but I sold all the ones that I allocated to sell, all the shares of ConocoPhillips, BHP, and the like. So you can see that what's the size of the portfolio? 2%. Did this drawdown drastically affect my portfolio? No. Okay, so position sizing is very important. You got to save those for your high conviction plays. And so if I get out of here now, we can, let me actually pull it up here. Let me take us back to the actual video here. 15%, just looking at it, I think that's a high conviction play. You must have extraordinary confidence to place 15% of your capital into one position. So for me, my highest conviction, well, it's kind of grown into that, is Google. Or Alphabet. Alphabet makes up above 20% of my portfolio, but my cost basis is lower. It's grown into that, right? And then I'm kind of just keeping it. But if I were to put 15% of my capital into a position, that would be a very high conviction play. And as we kind of went over in the video, that video about Netflix on Capital Mindset kind of showcases my thought process behind the plan. You have to institute a plan, and then you mix the analytical approach with the story-based approach, which we will do today very soon. And I actually, again, he shares his link publicly, but it doesn't show. This is why I have this open. It doesn't show the loss incurred, which again, I know that you guys have requested me to review this individual's portfolio, and I will get to that. I have already allocated the research into this person's portfolio and the returns thus far. But again, story-driven case study right here. Okay, so now I guess we're going to get into the actual thing that most people really want, and that is taking a look at the taking a look. Well, this is now the updated portfolio, but taking a look at some research. Okay, so let's look at this together and let's understand this together. So this is kind of getting into the story-based approach, and this, by the way, towards the end of this video, will be shared after this is published. By the way, it will be after this is published. Will be shared with everyone in the Discord community. You'll receive a link. So those of you who are watching who are in the Discord community, you're going to receive a link to just view this whenever you guys want. And over time, if I do another updated video, I will always use this, and I will make updates to this research sheet. All right. So this is just giving us a broad-based understanding of the business. So the first thing I want to actually highlight, and this is where we'll go first, and I'll zoom in even more. Just zoomed out. Totally meant to do that, guys. Is the United States market for broadband connectivity. So we can see here we're starting at 2018. And if we go even further, by the way, it gets up to like 100 million. 100 million was kind of like the peak, and then it kind of declined from there. So we can see the decline rates here, and we can see an acceleration occurred in 2021. This is probably an occurrence of 2020 in the lockdowns, but 2021 was a huge year, and then we're predicting normalization of this decline, but this decline can accelerate. And this number will come back later. Then over here, we can actually take a look at the prices. So the prices for starter cable, mid-level, and premium level. Oh, and by the way, before we begin, I want to actually state, if you guys see any spelling errors, laugh at me, because this was made late at night. So starter, mid-level, premium level, you can see the cost, and I just took the midpoint cost so we can kind of visualize that, the midpoint cost of each one. But yeah, so you can see that markedly they're very expensive, because then, and you might be saying, haha, but wait, Fabio, if you put all the streaming services together, they'll be about the same price. Not necessarily. So take a look at the competition of Netflix. So we have Netflix here, and I separated them based on their levels. And actually, let's include YouTube Red for now. So if I include YouTube Red, it populates. And then YouTube Red has obviously a 0, because you're watching it probably on the free version of YouTube. So it's ad supported. And then you have the standard, and then premium is the same. They don't have a premium. So if they don't have a premium, it just remains the same. Like you see Apple's is the same. Oh, and by the way, this actually should be, I should populate that there. All right, so Peacock, for example, has an ad-supported. HBO Max, that $9.99, by the way, that's ad-supported. Disney's, that is not ad-supported. That one is they have an ad-supported bundle with Hulu, which I didn't include, but you could include that too. And I just didn't even include Hulu, by the way, because I just assumed that Disney over time will actually just merge it into Disney Plus and not have Hulu separate like it does now, and it makes it a little confusing for customers. But right now, that $6.67 is the discount you get if you pay the annual. So, and then Netflix has the basic, and of course, Netflix announced that they're going to focus on producing a cheaper plan that is ad-supported, so kind of copying that HBO Max. But interesting to note that the HBO Max ad-supported amount is actually going to be the same price as Netflix's non-ad supported one. And also taking a look at HBO Max's $12.59, that's with the discount if you pay annual. Apple is straight across the board. Paramount Plus, that I think is the ad supported one, and then the regular. Yeah, those are basically it. So if we take a look at them bundled together, we take the basic and cheap. And we see that the difference is about 63.79% from the cheap version of cable. So because we're competing against cable, all these guys together, if you have all the services together, you can see that across the board, even including YouTube Red. And I have this option if I just don't want to include YouTube Red, because YouTube Red might be considered its own thing. But if we don't include YouTube Red, you can see that on the higher levels, standard and premium, it starts to become larger, right? Because if we include YouTube Red, it's smaller, the difference. And you can think of this as the maximum potential, not maximum potential, but the appetite of the consumer to replace cable with streaming. Okay, and then towards the bottom, we're actually going to see a visual. But taking a look at, again, just this visual right here with the numbers, it is still saying that streaming has more room to run, because the American consumer, at least in the United States, and I can think around the world, it will be a very similar thing. The American consumer, the price point that they can kind of take is still higher than where we are today if you bundled all of the streaming services. And I doubt it, because I doubt most people are going to bundle it all. I think, for example, Netflix is like a staple. People might choose Disney as well, and then maybe HBO Max. I don't think Peacock, most people would do that. I think I just do the ad-supported Peacock, really, because I only go on there for really one show once in a while, but I've already seen the whole show, which is The Office. So, don't really care for anything else on there. Apple Plus, don't really care for any of the shows on Apple Plus. Paramount, and I'm speaking for myself, I don't know about you guys. Paramount Plus, and we'll see the audiences, because, obviously I don't want to use the anecdotal. We're going to use the data. Paramount Plus is, also fine. I don't really watch anything on Paramount Plus. I don't really care, and obviously YouTube. So my time is pretty much dedicated to Netflix and YouTube. I have Disney Plus, but I really don't watch anything on Disney Plus. I used to be. I'm an ex-Star Wars fanboy. I don't really care for Star Wars anymore. All right. But anyways, again, taking a look at the percent or market share percent of that price, we have Netflix, you can see there, takes up the majority, and HBO Max. So this indicates the expensiveness. You can look at these percentages and think of how expensive something is. Of course, if we include YouTube, again, then Netflix does come down as terms of the expensiveness, and this is a comparison as in terms of percentage of the total. So if you were to bundle them all, of course, let's just go back to removing the point here to take is that Netflix is on the upper echelons of price, and then Disney's cheap relative, Peacock is cheap, Apple is very cheap, and well, and it depends on the price segment you're looking at, because I also wanted to do it based on price segment. You see that Apple, it gets more expensive when you compare it to the basic and cheap models. So as a percentage, you see it grows to 13.62%, but when you compare it to the premium versions of each service, it is the cheapest, right? So that's how you have to kind of look at that. And again, I'll again put this back and show you guys with YouTube included. Apple, it becomes even cheaper. All right, as a comparative analysis. All right, but removing that. So now we take a look at the Netflix users. So Netflix users across the regions, and we can see the average growth rates. These are going to come back to haunt us, not haunt us, but we're going to use these later on in the video. And then revenue growth. So you can see here, and I want to highlight this, the delta between revenue growth in North America and subscriber growth in North America. So you see that subscriber growth only grew 14.9% from 2018 to 2021. However, it grew 29% in revenue. So something happened. What happened? Price went up. That's what that tells us. Very simple. And then you can see here that price did not actually go up per se in, and this is, by the way, per user. We'll get to revenue later, but we know that, for example, in North America, the price went up because you can see it right there, 11 to 14. EMA went from 10 to 11. The one that did not go up is Latin America. So why is that the case? Well, remember that we're converting this to dollars. All this is in US dollars. And actually, to make it easier for our eyes, I'll just go ahead and make this adjustment for you guys here. So all this is in US dollars. And if you have currency risk, which is the case, you're witnessing it right here. So even though the amount probably went up, or the revenue went up because you see Latin America grew by 48%, the revenue per user went down because the dollar probably appreciated to their relative currencies. And then you see the total revenue per user grew 5.33% across this time period. So we are seeing growth, and again, the majority of revenue growth per user has been occurring in North America. So right there, you have to say to yourself, who's the most valuable customer presently? North American customers. North American customers to Netflix are the most valuable customers, followed by EMEA, then followed by Asia, actually, then lastly, Latin America. Okay, so Latin America, again, because you have all those currency problems, but regardless. All right, so down here, I want to highlight to you this visual. This visual is actually really interesting in terms of, this is February 2022, by the way. So this is mainly up to date. And you can see that broadcast takes up 26%, cable 35.4%. Streaming is now 28.7%, and of that, Netflix only takes up 6.4%. So here's a little bit of a caveat I want to say. So if I am watching HBO today, let's say I'm watching a show on HBO today, have I stopped my Netflix subscription just because I'm watching something else? No. So I hear this argument all the time, and there's this argument that there's competition for your eyeballs. And it's like, yes, well, that's true. But here's the problem. When you are a subscription-based service solely, that's not necessarily that much of a big deal as people are making it out to be. But when you're an ad-based platform, that is a huge deal, right? So YouTube, if I stop watching YouTube for Netflix, right, and I start watching Netflix, who gets hurt there? Well, obviously YouTube. Now, if I stop watching my Netflix show and I go on YouTube and I watch this video right here, does Netflix get hurt from that? No, because I'm still paying them at the end of the month. Does that make sense? So I hope that kind of gets in people's minds there, because it's a very important point, because I see it all the time. Oh, they're competing for your eyeballs, and it's like hurting them if you're watching something else. Like, no. That's so surface level. No. If it's an ad-based platform, yes. If it's a non-ad-based platform and they're making money through the subscription, they could not care less. All they care about is that you maintain that subscription. And I'll tell you, I, for one, am going to maintain my subscription to Disney Plus, even though I'm not watching it, because my wife or me or someone in my household, someone comes over, they might want to watch something on that platform. And let's say something it's better than buying the movie, which buying the movie will be probably more than the month subscription. So I'd rather have the subscription just there, and I'd rather pay them every month, and I don't really care about that. It's not a big expense. Netflix, kind of the same thing. I don't want to be caught without having Netflix and then wanting some form of entertainment. But if I'm not watching anything tomorrow on Netflix is not going to care. In fact, I probably haven't watched something on Netflix in the past week, right? But Netflix does not care. I'm still paying them at the end of the month. YouTube would 100% care if I didn't watch YouTube for a month, all right? If everyone stopped watching YouTube for a month, They would care, all right, because they're an ad-based platform primarily. Not many people are subscribed to YouTube Red. Hulu, similar thing, but Hulu has a huge ad-based platform as well. And then Prime Video would not care. Prime Video pretty much doesn't even care whether or not you watch their movies. They're basically just doing their spend, and then they just want you to have Prime, and it's included in there. So that's a very important point, very underrated point. When you hear other creators say that, question them on it, because that's so surface level. It's unbelievable. When it's an ad-based platform, absolutely. Okay, absolutely, they do care. Now, you might say, here's the point that you might say. You might say, well, hey, but if I find myself not watching that, I'm going to be more likely to cancel. Absolutely, but don't pretend that that's just hurting them completely. Like, oh, I'm not watching Netflix tomorrow, therefore Netflix is suffering. They're going to call me and be like, hey, can you please watch our shows? No. They just want the subscription at the end of the day, and all I want is access. I want access to content. That's what I want as a consumer. And we're basically breaking it down to its core level. Access. All right. Now let's move on to content analysis. So here is actually broken down in 2022, 2021, and 2020. This is 2022 so far. All right. But I want you guys can obviously see through this visual, there's a theme here. What's the theme here? Well, I've actually had comments or discussions with people on Strongman Personal Finance's live stream with the fellow panelists, and some of them have said that they don't like the shows on Netflix. And I would say that we want to be careful with anecdotal pieces of evidence. Like, for example, I say some anecdotal things, but I always highlight to you guys, this is anecdotal, take it with a grain of salt. So I don't like to use that. I'll use the actual data from the audiences, and these are the top shows according to data provided by Nielsen and other actual platforms, because we'll actually see other ones. But so according to this, we see that in 2020, there was one show in the top 10 that was not Netflix. One show. In 2021, we can see the top 10 again. One show, a single show that was not Netflix in the top 10. I included the top 15 for 2021 because the data was available. And you can see there that there was one from Apple, the Ted Lasso show, whatever that is. Never heard of it. And then WandaVision made it to number 14. And you probably know some of these. So Lucifer was actually number 1 in 2021. Lucifer, not Squid Game, Lucifer. And then the Great British Cooking Show, Virgin River. I haven't seen a lot of these, by the way. I have not seen a lot of these. Then we go to 2022. We see again, The Last Kingdom, Bad Vegan, Inventing Anna, Pieces of Her. I want to see Peaky Blinders. Peaky Blinders will probably be on there before the end of the year, because I know there's a huge fan base for the Peaky Blinders. And you see right there, Amazon's actually made it into the top 10 twice. But this is the first year here so far, though, that Netflix hasn't taken 9 out of the top 10. Oh, they only have 8 out of the top 10. It's like, oh, okay, Disney Plus is not making it on here. I got to tell you, like, again, The Mandalorian made it in 2020, but, okay, anecdotal evidence here. I was a Star Wars fan. My wife could not care less about Star Wars, okay? And who dominates the market? Is it people like me, or is it people like, my wife, or women, basically, in general, So we're getting right down to it. Like when we do like an analysis on Target, do we care about what I think? Do we care about what someone like my wife thinks? We probably more, as a market analyst, care more about someone like my wife thinks. Okay, so yeah, Mandalorian made it into the top 10, and so, but it didn't really continue. It's kind of faded off. Taking a look at other forms, we take a look at hours of original content on Netflix. You see that it's massively grown, and since then, they've actually vastly improved their dominance in the top shows. Okay, vastly improved. And you can see here further data in terms of the top shows here. This has Cruella, Disney Plus, Cinderella, 2021 on Amazon, Afterlife Party, Netflix, Hulu, Netflix, Disney Plus, Netflix. You still get the point here. And then you can see the number of streamed minutes. Okay, so Cruella definitely had a massive amount relative to everyone else, but for the most part, it's still dominated by Netflix. But again, does it matter that I'm going on Disney Plus? Does that hurt Netflix? No, because if I go tomorrow and I watch a Disney Plus show, and let's say I binge watch the whole Mandalorian for whatever reason, let's say I do that. Does that hurt Netflix? Did I unsubscribe to Netflix? Not necessarily. So we got to look at this in terms of context. All right. So then now we're going to look at content spend. All right. So remember that I've already tried to dispel the notion, because I've heard some people say that, and I think that's so interesting. And by the way, the asterisks implies estimates. So estimates, if you see an asterisk, it means an estimate. It's because obviously we haven't gone through 2022. All right. But the notion that Disney has a massive library and they don't have to spend on content. And we did this on the Disney video. Go check that out on the Capital Mindset YouTube channel. But Disney has this massive library and they don't have to spend on content. False. They are spending even more on content than Netflix. And if you look at the cash flows, it's the same thing. If you're looking at the cash flows and you're judging a business like this based on the cash flows, it's going to harm your ability to make an accurate prediction. Something like Apple, it's not, because if you notice that Apple's, relative to their cash flows, this content spend is nothing. It's literally like a drop in the bucket. Apple's the most scary one. If they are able to succeed in this, is the scariest one, in my opinion, because Apple, okay. But anyway, we're not talking about them. So look at Disney. Disney's spending a ton, and it seems like it's not really like getting them anywhere for now. For now, it's not getting them anywhere, but they are continuing to make that spend. And the thing is, you can have a lot of money and you can spend a lot, but it has to be on what people really want, on the quality. So, for example, like anecdotal evidence, in my opinion, they absolutely butchered the IP of Star Wars. I don't care for the franchise at all anymore, and I'm not really excited about anything unless they make a Vader TV series. You see, like Disney, if you're listening, make a show from the perspective of Darth Vader after Order 66. Oh, I'm back on. I don't care. I'll watch it. Kenobi, I might watch Kenobi, but, make that Vader show. Oh, I'm back on. Let me know down in the comments below what you guys think of Vader TV series. Like, you get to see what Darth Vader does from his perspective after Order 66. Oh, done. I'm totally going to binge watch that. All right. But I'm paying Disney anyway, just so everyone understands. I'm paying Disney anyways because, sometimes there's maybe a movie on there I'd want to see. Okay. And I'm still paying Netflix. And I'm still paying Amazon. Oh, gosh. But I'm not paying Apple. You don't have my money yet. You have my money because I'm on the iPhone subscription plan. So you know what? You still win. You still win, Apple. Oh. But anyways, you can see everyone's kind of spending more. And it's kind of like this preconceived notion that because you have a massive library, you don't have to spend. False. You still have to spend. Consumers constantly want newer stuff. Sure, I'll go watch an old thing, but I don't really do. Anecdotal, but even like looking at what audiences do, most consumers like to prefer to watch newer things. And you know what I just noticed? And I'll have this actually put on there, but HBO's or Warner Brothers is missing on here for some reason. So you guys probably caught that, but Warner Brothers is missing on here. It's probably around the same line, but the point is to highlight on Netflix. And I guess arguably Disney Plus is the scarier competitor. So I didn't miss the scarier competitor. In my opinion, Apple's pretty terrifying. Same with Amazon, but whatever. Which, by the way, I watched Jack Reacher, and that was a pretty good show. All right. Anyways, another source here actually providing further, scoring on popularity. So we can see here clickbait, money heist, turning point, only murders in the building, Hulu, Grace, or I'll just say the Netflix, Hulu, Netflix, Disney Plus, Netflix. Again, Netflix dominates here again in popularity. So I guess I made a point here. This is, again, kind of like a broad level analysis of the content. We did a market analysis, content analysis. Now we're going to actually take a look at growth potentials, and then we're going to go off into the model and then get to a price point, right? So here we're going to start analyzing something, and I'll actually start with North America because North America is going to showcase a little bit different stuff, but we're not really going to utilize it too much. We're going to utilize the stuff more at the bottom. So when we look at the subscriber base. We're starting at 73.9 million subscribers. And then so we can see the average growth has been about 14.919%. I just threw in 5%. So I said they are going to decline in terms of that growth rate. And I think year over year, they still grew at like 6%, but it's quarter over quarter that we saw the decline. But, you know, year over year was still an increase. And taking a look at, and by the way, that was, I think, global subscribers. And you have to take into account, and I haven't even mentioned this yet, they essentially nuked an entire country, you know, hypothetically speaking. They nuked an entire country. And that, with that being said, they still technically grew if you remove that event, extraneous event. And that country is Russia. They're out of Russia, so that should be okay. So I'll remember to say that in the conclusions. But taking a look at the growth rate, I just implied a 5% growth in the United States or North America, so it includes Canada. And then so we take a look at the households, and I actually reduced the households to be a little bit more conservative on the terms of total complete potential. And then we see that household growth, I just grew it with the average population growth. So we don't want, for example, the subscriber count to be greater than the household. That wouldn't make any sense. So that's what that's there for. These household numbers are there to kind of smell test your predictions. All right. So my prediction of about 109 million households is still reasonable, and still implies there's a lot of people that still are not subscribed to Netflix. Households, not people, households. I want to be very clear. Households. And I was, again, a little bit more conservative on the number of households. I try to be more conservative on the households when I could be, because conservatism in terms of projections is better than aggressiveness. Okay, so, and this adoption percentage comes from the decay rate of cable. So cable is about decayed on average about 4 to 5%. So I put a decay rate of 5%. You see that cable started here. Remember, a peak of cable was about 100 million. So 100 million households we're subscribed to cable, and cable is way more expensive than something like Netflix. So we can see here the decay rate continues, and we project that in 2030 the cable subscription rate will still be about 45 million. That might still even accelerate, and then I say from there the adoption rate is only 10% of those that drop cable. Those cord cutters is only 10%. But that's to give you an idea of the additions. Okay, so I didn't actually add these in. These are just added with the growth rates. But this gives us an idea of that. It's just for visualization purposes. And then so what I want to state about that is a lot of cord cutters, do you think that they don't have already Netflix? That's what I want to actually state, why the adoption rate I put so low. Because a lot of them already have Netflix. That's why you're cord cutting. You're cord cutting because you're like, I have cable, and then I have these subscriptions. I watch more of the subscriptions than I do cable. I'll just cut cable. Screw cable. And then, yes, that's basically what occurs. So the penetration is much larger than what people really realize. So some people think that the entirety of the cable subscribers is the potential for growth for Netflix. No, bad, noob tier. You have to, from that, assume that a lot of those households already have Netflix as a subscription, or Disney Plus, or etc., and they're just making the switch over. So they're already customers. Remember, if you're a subscription-based model, you do not care necessarily if they're watching you too much. What you really care at the end of the day is that they're just subscribed to you, and that they remain subscribed to you. The retention or the viewership amount tells you if you're the least likely to be cut of the subscriptions. That's what that tells you, okay? So it says to you, of the services that they have, I'm the least likely because they watch me the most. That's the important part. Unless you're ad supported. If you're ad supported, you do care because you're ad supported. You need them to watch. You need eyeballs, all right? You're under more pressure, which is why, again, you look at news outlets, and news outlets are very sensationalist, as we covered on CNBC, because they're trying to get eyeballs and because they're ad supported. That's how they make all their money. All right. So looking at the different markets, I see here, well, not I see here, but I kind of grew it at different rates. EMEA, I grew at higher rates. I think that's fairly reasonable, by the way. 12% is fairly reasonable. I'm probably being overly conservative in this regard. But we can see here that at a 12%, well, actually, no, I don't think I'm being. Let me correct myself. I don't think I am being, but I am being very conservative on the household measure, because the household measure is just Europe, just the EU. This is the EU. and I'm not including the other parts that actually represent that. So I'm being hyper conservative in that. And so you can't really say I'm being aggressive there. But I'm being hyper conservative there because we're only including the households of the EU. And, you know, it was fairly easy to access data, but I thought I'll just be more conservative. And then so I do assume that the 12% growth rate towards the end, that probably is conservative. Let's be very honest with that. That's probably very conservative. But you'll see why in a second, because I think that when we take a look at this huge market, European Union is where most of the value comes from. The other markets, the value isn't really there yet because those economies are rather small. The people are rather poor. But the economies are growing. And so as they grow, the value will somewhat be realized, but not nearly as much as what is already there in Europe. So the European market is very valuable. And so the growth rate, I tempered it down to kind of accommodate for that, just so we're clear. But arguably, this could be higher, but I'm just being conservative because I'm trying to get to a conservative growth measure. All right, so then we have, and again, that's why the population growth is higher. You might say, like, Europe's not growing like that. I know that. It's because I'm including, you know, some aspects of growth from Africa, from Middle East, etc. So Latin America, we do see some, again, I kind of tampered down the growth rates to about 10%. Population growth is about 0.8%. That's what statistics showed. Population growth in Latin America is slowing down. I think now it's at like 0.9%. So I slowed it down, averaged it out to about 0.8% for this decade. And then also Asia and China. This one technically should actually be about 1.2% or 1.5% actually. But we'll do 1.2% because we are excluding China, by the way, and China is a slowing population growth. But taking a look at this actually should definitely 1,000,000% be higher. And I didn't even include that, but we're going to probably put this up to about a 20%, and I'm still being conservative there. Because this is excluding China. You can see that the potential, even if they grow at 20%, which seems like a lot, by the end, the penetration won't even be that much. And this is assuming over the next decade, we get higher internet penetration in Asia. We get higher economic growth in Asia. And I think a lot of you out there, because you guys are invested in Asian companies, do believe that Asia is a growing market and it will enrich itself even more in the coming years. So that's where we get that from. And then taking a look at the growth rates, I think these are fairly conservative and fine. I am assuming that Latin America grows at a much slower rate over time, but you know, again, we have seen a decline, but that's more of a cross-currency risk. So I just tamper it down there. I think it makes up for it that I implied a lower growth rate. So you guys can kind of see that the numbers should end up being more or less the same because I'm actually more conservative on the growth rate in terms of subscribers. So that kind of makes up for the potential decline in revenue per user. Okay. So again, the goal is to end up with a conservative measure. And then here we get the total revenues projections. And, you know, fairly straightforward here. It does assume that with this, and you can see where the potential really comes from. It comes from, I think it's Asia. Asia is where massive potential really comes from. Right there. So from 3 billion in this year to potentially about 17 billion in that year. And this is assuming these rates stay relatively the same. Let's just say it doesn't even grow. So if it doesn't even grow, we can see just based on that growth rate, it could get to 88 billion. And we can come up here and let's just slow it down. Let's say instead of 20, it grows at 15. And we can see again the smell test. That's pretty reasonable. In 10 years, we still see it's a very small penetration, and then you can see now it is tampered down a bit once we do that because now Asia is only about 9.9. It does imply that North America does grow decently just on the subscriber growth being much lower than historical and price growth being a little bit slower than normal. So because price growth has been about 29%, I just lowered it, all right, to just 5%. Because I assume, like, let's say they grow at 5% per year on that price. I think that'll be fine. I think most people will be able to swallow that, all right? So regardless, I think it's fairly important that we kind of acknowledge then the final growth rate that we come up with is potentially about an 11.24% growth rate. All right, with that 11.24% growth rate, we will then now go head over to the model. Okay, so let me pull it up. Well, it should already be pulled up. All right, so I'll zoom in for everyone to watch a little bit better. So it's already kind of plugged in where we actually need to. And this will be using, again, net income primarily, and it just did its little thing. Net income primarily as its source of valuation, because if we actually understand where Netflix, or what happens to Netflix, is in the cash flows from operations, we are expensing a massive amount of money in terms of growth in content. And that growth CapEx, we're basically punishing the company. So it's very difficult to determine whether or not what is the growth CapEx, what is the maintenance CapEx. And I say CapEx lightly because it's not technically the line item CapEx, but it is the content spend that is the important measure. So looking at, for example, something like Netflix, it is actually good to use GAAP net income as a measuring stick for how the company is doing. Believe it or not, that's what GAAP net income was designed to do. And in this instance, I actually tend to lean on that. And that's where I'm saying that was the primary mistake of Everything Money and Cameron Stewart, CFA. Those two creators made that very big mistake. And I actually saw a creator that did a very good job of doing this. And I think they deserve credit for this. And it's Hamish Hodder. Hamish Hodder is an Australian creator who I actually took a look at his older video on Netflix. And he did post it, I think, after. But it's not that he definitely saw it. He came to the same conclusion I did. And that's just saying that I'm highlighting that he's correct. He's absolutely correct. His analysis of Netflix in terms of highlighting that, hey, Netflix is, you can't evaluate it based on the cash flows because of this reason, was beautiful. It was chef's kiss and was very easy to understand. So he did a very good job in terms of providing value in that video. So I want to give him credit and actually say that is a person who understands more about the nuances of accounting, definitely has studied it. I can tell you that just based off of how they were explaining it. They definitely studied it and works in it. The other two creators, while the other one of them is a CFA, failed to unlock the nuance there, which is quite disappointing. And then the other guy, I mean, I won't really say anything else about the other guy. I don't really know anything else about him. Sure, he's a great person. Some people might not like the way he says some things, but he definitely has some noob tier investments and some noob tier analysis that I've talked about in the past. And, you know, talking about Netflix's cash flows is an example of that when, repeating the same mantra over and over and over again is all well and good and easy to understand, but, can get you in a little bit of trouble. But again, Hamish's explanation was pretty good. So I'll just say that. All right, so now back to the evaluation here today. So taking a look at Netflix, I did actually assume that we're going to have the equal amount of share dilution going forward. And if you look at the cash flows, you can see that some of these metrics are kind of out of whack. It does imply that the cash flows are not there because you see the price to free cash flow is negative. The PE, however, is a positive. And sitting here today, it is actually below that 18. So I think the conservative measure of growth is that 10%, but I'm going to imply a 2%. As the low rate, okay? And then you can see here, if we're discounting it with a 50% margin of safety, the buy prices for that conservative rate is about 134. And I'll tell you this right now. That's the price in which I would make this a very large position. I kind of stand by what I said in the past. If it reaches $134, it would be a very large position. Now, doesn't mean I'm not buying now. No, I am buying now. I have a plan, okay? I have a plan. If you guys played Red Dead Redemption 2, I have a plan. Sorry, we have to insert jokes here because these are stock videos and jokes are important for sanity. So taking a look at where it is today, it actually just hit about $218 now, so great. Which is actually around the price where I bought, so it's actually back down there. So if it continues to drop, I will continue to add. This is another meta example. This is another one happening, and it happened at a perfect time period, which we'll end by looking at my portfolio, and I'll talk a little bit about it. But just so everyone understands, my price where I would be buying heavily is at my conservative growth rate. I do think that it is possible that it grows at like 2%, just so we're clear. So that's why I have it in there. But I think that a conservative measure is still 10% for the next 10 years compounded. All right. And I think they're going to grow higher than that if I'm being honest about it, which is why I am adding here. And then I will be scaling the position and then having a massive position if it were to get to 10%. So to reiterate the lesson learned from the teacher, we'll call him a teacher at this point, Joseph Carlson. He showed us the implications of what happens when you're story driven. So here I hope to have shown you guys that you guys can be both story driven and analytical about the approach, understand the business, understand the market, understand the prospects of a business in the future, understand that the story maybe today is a little bit simplified regarding, subscriber declines and the like. But up here today, we are looking at the growth rates of 10%. I think I've shown that, it's fairly conservative. And the growth rate in the past couple years has been pretty strong. So I think it's been, closer to 20-ish%, okay, in terms of that. So I think the 20% is still potentially a possibility, but an unlikely one at that. So that's why I have it marked at a 2% weighting in terms of probability, and then somewhere I think between 15 and 10% is more likely. So if that were the case, I would start to add even more heavier at below $184, and that's why these prices are here today. So I hope that helped, and then we're going to finish off with the portfolio. So let me actually pull that open real quick, and then after this analysis of the portfolio, we will close off. And if you guys still made it to the end of this video and you found value in it, I hope you have a great one. But if you guys want to click off here, that's fine. But here's a discussion about the portfolio. So you can see here now in the portfolio, and I see there's at least 3 of you in here. I have you removed from this video, so don't worry. And we can see here that Netflix makes up about 3% of the portfolio. So if you guys remember the screenshot, it was less of a percent of the portfolio. So now it has increased by at least 50%. And taking a look at the amount, and by the way, the percentages, you have to consider the fluctuations between me adding other positions and stuff like that. So so take that in mind. But we are still down 18.92% in the current holding of Netflix. But I will tell you, as the price continues to drop, oh boy, that allocation is going to increase, and then my average cost is going to definitely decrease, and I'm going to be very happy about it. So again, I stick by with what I've been saying about Netflix. I think that Netflix as a business is fantastic. I like the story. I like the potential implied in Netflix stock. I have a plan. You always have to have a strategy, and this is another lesson as to allocation. This drop, did it affect my psychology? Absolutely not. In fact, I think that there needs to be more videos out there that I'm seeing, because a lot of the bullish people on Netflix are now kind of scared of Netflix. No, I am bullish on Netflix. I'm getting more bullish on Netflix as the price continues to drop. This is another example of Meta. I made videos on Meta in the past, where I added to Meta, brought the cost basis. Well, actually on that one, I was bringing the cost basis up, funnily enough, because I already had it. But I was adding more and more to Meta, and I'm adding it to a portfolio of businesses that I think are great businesses, okay? On that note, guys, thank you guys so much for watching. This is a very long video. And if you guys made it to the end of this video, you guys are champs. You guys definitely do not have the attention span of a goldfish. So if anyone ever tells you that, you can tell them you watched this video, and that alone is evidence against that. All right. On that note, guys, thank you guys so much for watching. I hope you guys have a great one. I'll see you guys on the next one.